Hi everyone, it's Martin here. As we crawl ever closer to the end of this horrid pandemic, attention is starting to turn to the post-pandemic economic recovery. It's fair to say that politicians and business leaders are all keen to build back better in the wake of COVID-19. I know that build back better is a phrase that triggers a few people due to its association with the Great Reset and World Economic Forum, but build back better in this sense is about tackling some of the economic inequalities seen across the UK, especially in a geographical sense. Today we've seen a report that the London Stock Exchange is planning to launch a £300 million investment trust designed to boost the survival prospects of businesses hit hardest by the coronavirus pandemic. Sky News is reporting that London Stock Exchange Chief Executive David Schwimmer, no, not that one, is in talks with various fund management groups and also HM Treasury officials about launching the investment vehicle to be called the UK Growth and Resilience Fund. Once launched, the investment trust would principally invest in unquoted companies, that is, companies that are not currently listed on the London Stock Exchange. Before I get into this, my sincere thanks to everyone who has generously supported my channel to date by hitting that like button or pressing that little red subscribe button to become part of our subscriber community, liking and subscribing. In fact, any engagement with my videos makes a significant contribution to improving their visibility in the YouTube algorithm. So by pressing that like button and by subscribing, you help my videos to get seen by a brand new audience who hopefully will do the same, and so the cycle can continue. Back to the UK Growth and Resilience Fund. Sources say that BMO Financial Group, JP Morgan Asset Management and Octopus Ventures are being lined up to manage three different strands of the fund. BMO would focus on private equity, JP Morgan on listed small cap companies, and Octopus on venture capital. Healthcare and technology companies are expected to be a particular focus of the new fund. While the London Stock Exchange Group won't be a direct investor in the UK Growth and Resilience Fund, it will apparently waive most of the fees typically charged to newly listed companies. The fund would initially aim to raise around £300 million, but that could be expanded to £1 billion in time. Sky News says that one of the ideas being discussed is for seed capital for an initial public offering, an IPO, being provided by those businesses which have done particularly well throughout the pandemic, so supermarkets and online retailers, for example, but also from businesses that have received government financial support. The article says that it remains unclear whether these businesses have yet been approached about their willingness to support the investment fund. I really don't like the idea of businesses that were effectively bailed out by the taxpayer being one tranche of the seed funding for this new investment vehicle. If they don't need this government funding, they should pay it back, as we've already seen when it comes to business rates relief being repaid by some of the supermarkets. What they should not be doing is ultimately profiting as investors in a relatively high-risk fund. Rumoured to be in the run-in to become chairman of the UK Growth and Resilience Fund is Simon Fraser, a former board member at the bank Barclays. Fraser is chairman of the Investor Forum, and the Investor Forum promotes corporate governance, representing institutional investors in UK equities. Someone with experience chairing that agenda would seem to me to be the right fit for this new project. The article from Sky News quotes a City source as saying that the fund is being described by the London Stock Exchange chief exec as potentially a once-in-a-generation opportunity to help with the government's levelling up agenda while providing investors with attractive long-term returns. And another source said this could logically fit within the Build Back Better narrative that ministers are focused on. The same source referred to the social impact potential of this plan, which could help to boost the reputation of the UK's financial services sector. They refer in the article to the recent reputational damage caused by insurers refusing to pay out business interruption claims, a decision largely overturned since by the Supreme Court. It sounds like it's still early days and that there's a chance that the UK Growth and Resilience Fund won't go ahead. The article refers to the complexity caused by the multi-manager approach as something that could prevent the idea from being delivered. The article then goes on to explain that the proposed launch underlines concerns about the long-term scarring of the economy and certain industries which have been rocked by the ongoing impact of the coronavirus crisis. It's definitely early days. I love the idea, I love the concept, and it's positive to see the London Stock Exchange, fund managers and the Treasury thinking about life after the pandemic. If the UK economy is going to prosper in the future, we absolutely need vehicles like this to raise money that will help smaller, innovative companies to grow. If those investments can support the Build Back Better agenda and help to iron out some of the geographical inequalities seen in the economy, then that's a positive too. From an investor perspective, clearly we need to wait and see the mandate of the UK Growth and Resilience Fund and the sort of companies in which it invests before we can get a measure of the risks involved. Whenever I hear about investing in unquoted companies, the warning bells go off in my head. This is going to be at the riskiest end of investing, not quite up there with speculating on the price of Bitcoin, but certainly at the risk of total loss end of the market. Those investment risks can be reduced to some extent by diversifying the portfolio across different sectors and different sizes of businesses. But investors who are hearing about unquoted companies, health and tech sector investment, and venture capital will quite rightly draw some parallels to the relatively recent failure of former Star Fund manager Neil Woodford. Do you think this investment fund idea could help the UK economy build back better post-COVID? Let me know in the comments. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.